Last week, there was a strong short squeeze in the American stock markets. This means that when those who were trading downward positions were squeezed to close their positions, there was a sharp upward movement. Was this the beginning of a Christmas and year-end rally that will continue until the end of the year, or was it just a short squeeze? In the upcoming week, the macro picture will once again take center stage. Markets will regain their composure, and we will see if the trend turns downward again. In this video, we will evaluate these factors. Let's get started. Agenda and market analysis. Yes, the American stock markets had one of their best weeks almost all year last week. They closed the week with gains on all 5 days, especially the Nasdaq, but even the S&P and the Russell 2000 joined the rally. We've been analyzing market fluctuations for months now, but what's interesting is that, besides the Magnificent Seven, meaning the 7 largest companies, there were generally not many major disruptions. In fact, last week, we saw some short squeezes, some rallies, and some healthy movements in other stocks as well. From that perspective, the analysis gains importance this week as we also witnessed some healthy rebounds when looking at stocks moving to the downside. However, these rebounds were mostly limited to the large-cap stocks, and we can say that real money is flowing into the system, resulting in a significant shift. For instance, Nvidia dropped below $400 and then climbed back up to $450 within the week. Tesla, despite disappointing earnings, managed to consolidate, and Apple, despite a very negative and unsatisfactory earnings report, even attempted to recover. Similar scenarios can be observed as well. Therefore, when we look at the bigger picture, the macroeconomic landscape still contains challenges. For example, the Fed's stance on the market, which has not been priced in yet, particularly when it comes to rates. Powell delivered a speech just as expected, without changing any sentences, but the market responded with, "Okay, so we're starting to ease here." As I mentioned in previous weeks, I'll address the divergence in the 10-year Treasury yields in the upcoming Week 3 video. I'm expecting a reversal there, but we need macroeconomic improvement for the sustainability of the move. Now, let's take a look at historical patterns. For example, let's see what happens after the Fed stops. There are instances where the Fed paused after raising rates, and then, there's a period where they start lowering rates. When we look at historical examples, we can see that markets, especially in 2000 and 2008, didn't turn very negative right after the Fed paused. They usually tried to go up for a while, and then eventually turned down. In fact, in the big picture, after the Fed paused, a general trend is that it often leads to a recession in the economy, and as a result, they have to lower rates. So, if the Fed pauses and starts lowering rates again, this would likely be a sign that the economy is deteriorating further, and it could signal that things are getting much worse. As for the real economy, one of the most crucial indicators is related to shipments and product traffic. The CEO of Uber's freight division has stated that there's a significant freight recession happening. He mentioned that international trade is abnormally slowing down, with a 10% decrease compared to a year ago. This signifies a significant issue in the international traffic and suggests a decline in goods traffic. Similarly, one of the world's container giants, Maersk, is reportedly laying off 10,000 workers. This shows that international trade is facing severe challenges. Slowdowns in transportation, just like the decline in international trade, are expected. So, the impact of war, recession, high interest rates, the global economy, all factors to consider, and it seems that things are truly getting challenging. Meanwhile, while things are getting difficult, how is America's debt situation? In this graph, you can see the ratio of the potential GDP of the United States to its national debt from 1900 to 2053. There has always been a certain level of debt relative to GDP, but in recent times, there's been a rapid acceleration. The debt-to-GDP ratio for America has been on an abnormal and negative trajectory. If this pace continues, it's inevitable that things will go out of control, and it will lead to a major crisis.